Hi, this is the RITE Report Show, and this is and I'm your host, Chris Angle. I'm the author of 4 books in philosophy, and these books are available free for viewing at thephilosophicalangle.com. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale and has MBAs from Wharton and also from Tufts, and Rick is an independent venture capitalist out in the West Coast. And approximately once a month, we put out a report on the state of the stock market and the economy. And this program can be seen at www.stock-market-direction.net, and that report will be up on the on that website. And it's this program is a natural outcome of one of the books that I wrote. It's called The Philosophical Equations of Economics. And so let's get into it here and see what the report says for the coming month of January and early February. And so first we're going to do is we're going to check out the macroeconomic snippets of the RITE Report, and we're going to first go over the negative snippets. And the first one is from the U.S. Census. The U.S. retail and food service sales for November decreased 1.1%. And a report from the Chicago Fed indicated slower growth in employment and production-related indicators, and was down 0.2% in November. Sales of new family homes in November, this was 11% below the October, and personal income decreased 1.1%. Inventories, end of month inventories were down 0.1%. COVID-19, from the KC Federal Reserve, showed that employment among low-income individuals fell by 31.6% between February all the way and April, compared to a decline of 15.6% in the overall population. And it's led to substantial declines in employment in the United States overall, especially among low-income individuals. Productivity increased 4.6% in the non-farm business sector, and in the third quarter, and unit labor costs decreased 6.6%. Manufacturing corporations after-tax profits were $148 billion for the third quarter, and which is up from the second quarter. It says here, maybe that should be oh yeah, this is the positive. We're now in positive economic data snippets. Okay, that's good. And in manufacturing, productivity increased 19.9%, and labor costs decreased 12.1% from the Bureau of Labor Standards. From the U.S. Census, seasonally adjusted after-tax profits for retail corporations were up $4.7 billion from the second quarter. The October 2020 sales of merchant wholesalers was up 1.8% from last month. Averagely hourly earnings increased 0.3%, and real average hourly earnings increased 0.1% over the month in November. And the estimate of U.S. selected services total revenue for the third quarter was an increase of 7.8%, and U.S. Total business end of month inventories were up 0.7%. U.S. total business sales were up 0.9% from last month. Privately owned housing starts in November, this is up 1.2%. Outstanding balances on small business, commercial, and industrial loans in the third quarter grew over 80% compared with the third quarter of 2019. That's from the KC Federal Reserve. And from the Bureau of Economic Analysis, real gross domestic product increased at an annual rate of 33.4%. New orders for manufactured durable goods increased 0.9%. World trade grew again by 0.7%. November 2020 end-of-month inventories were up 0.7%. Advanced international trade deficit in goods increased to $84.8 billion. And the total construction activity was 0.9% above October. And new orders for manufactured goods in November increased 1%. So if we so the number of snippets were 76% positive and 20% negative, which is essentially the same as the last couple of months. So that's pretty good. And economic analysis indicator summary. That we choose about these indicators to determine to indicate how the economy is doing overall. And high yield bonds went up over the month. The iShares Select Dividend was up over the month. ISM Purchasing Managers Index was 60.7, and so the economy is expanding. And with the IHS PMI also indicates that the economy is expanding. Construction spending was 0.9% up, so positive. Unemployment rate is decreased to 6.7%, positive. And the civilian force participation rate, however, decreased slightly. The employment population ratio also decreased. And the Conference Board's Employment Trends Index is positive. So 2 positives, 2 negatives will give it a neutral. From the Bureau of Labor Standards, again, productivity increased 4.6%, output increased 43.4%, and in manufacturing, the productivity increased 19.9%, and output increased 56.2%. Stellar. Okay, so that's a big positive. U.S. manufacturing corporations after-tax profits were up, and advanced estimates of U.S. retail and food services for November was up. Well, a decrease of 1.1%. So that's a negative. And from the manufacturing and trade incentive and sales, the combined value of distributive trade sales and manufacturer shipments was up 0.9%, positive. The industrial production index from the St. Louis Federal Reserve upticked, so that's a positive. And year over year, by the way, it's also positive. The velocity of money upticked, and we'll put that as a positive. And new residential construction was 6.2% up, positive. Conference Board leading economic indicators increased, positive. Conference Board coincident economic indicators increased, positive. New residential sales was down 11%, negative. Advanced report on durable goods manufacturers, shipments, inventories, and orders was a 1.8% increase, positive. Existing sales was from the National Association of Realtors was a negative 2.7%, negative. And the real GDP, as we mentioned above in the snippets, some of this is repetitive, is 33.4%, positive. Personal consumption expenditures was down 0.4%, so that's a negative. And personal income down 1.1%, negative. Consumer confidence from the conference board decreased, so that's a negative. Restaurant performance index is contracting, so that's down. Corporate profits, let's see, from current production increased in the third quarter, positive, and new orders for manufactured goods increased 1%, positive. Also for world trade volume, as we mentioned above, 0.7% increase, and the Chicago Fed National Activity Index was down 1%, negative. Okay, so housing prices rose nationwide, and our housing prices rose 10.2%. So we're going to give that a positive. So in summing that up, we got 19 positive indicators, we got 8 negative, and we've got 1 neutral. So we're also going to make, we're going to add up our scale of our RITE Report Strategy Index and domestic political risk. This is going to go down to a -5. The Democrats have captured control of Congress and the executive branch. Their campaign rhetoric indicated a preference for future tax increases. Near-term plans are not clear, so we're going to give that a negative. Tax risk. So far, corporate taxes remain in place, so we're going to keep that as a +8. Individual incentive freedom. Regulations are likely to increase with the Democrats, but they haven't occurred yet. We're just going to give this a neutral score. Production of knowledge is going to remain high. Government and corporations are spending money on research, especially with all the stimulus being produced by Congress. That's going to continue, so we can expect this to remain high. Technical analysis of the markets. The markets continue to go up, so we're going to keep this at a high rate. We're going to have +8. The general business and economic snippets, as we saw above, we're going to keep that at +5 because it remains high at 76%. And the economic indicators, the summation above that we did was 20, slipped from 23 positive and 4 negative and 1 neutral last month to 19 positive, 8 negative, and 1 neutral. So this is going to slip down a little bit, and we're going to call that 3.6 here. And its total is 27.6. And so the RITE strategy fell a little bit last month from 76% to 69.7. So it fell slightly from, well, a significant amount compared to the last 3 months. And so we're going to make a summary here. The RITE report came out with a summary that in spite of the market suffering a devastating downturn from the epidemic, it is now recovering due to the positive business and economic news, along with positive developments in medicines, treatments, and vaccines for COVID-19. However, the RITE Report Strategy Index slipped several points due to uncertainty of the political preferences of the new administration, which will control Congress and the executive branches. Until these preferences and plans of the new administration are known, the RITE Report recommends safety and caution, and thus hereby recommends to go to cash for the immediate future. Until next month, when a review of the new administration's policies can be understood, the RITE Report recommends go to cash for safety. So let's ask Rick what his thoughts on the stock market and the economy.
Well, first of all, anyone who got into the stock market last March or so is sitting on significant gains. So there's no risk in going to cash. And I think certainly downside risks on the regulatory side are very significant. Biden's as much as said so. So elements of this Green New Deal, whether they pass the legislation or not, through regulatory fiat, they will introduce some very severe regulations that will impede dramatically basically the entire energy industry, because as they've long stated, have a strong preference for converting to electric vehicles and non-oil-based or fossil fuel-based power. I think all up and down the line, you're going to see subsidies introduced to boost wind and solar and everything but fossil fuel. So that, I think even if as a result oil prices go up, as they inevitably will, for people or companies in the energy industry, life is going to be very difficult, and that's a big sector. So that's one issue. I think it's obvious that the gap between the wealthy and the poor has already increased dramatically and will continue to do so going forward. Many companies have already decided that it makes more sense to have people work from home or from outside of the office. It lowers their liability, and they're going to continue doing so. And so the commercial real estate market, I don't see recovering anytime soon. Not even 5 years from now. So that is a huge negative, because that's a gigantic sector. Of course, all the press is, concerns and covers the residential sector, which is, doing very well, but you have almost zero mortgage rates. So you're going to have the kind of speculation, with second homes and so on and so forth, that you would expect when interest rates are low, and they're going to remain low because you have extremely dovish people that are that will be appointed by the administration in Treasury, the Fed, and so forth. So the policy has been dovish already. That will continue, and if anything, it will become more dovish. I think the deficits will continue to be enormous. I think the adoption of modern monetary theory by the Democratic Party, even if it doesn't become an official policy, will essentially ensure that they will run large deficits to achieve their policy goals for years on end. So, whereas we were initially shocked by trillion-dollar deficits in the early stages of the Obama administration, that should be considered relatively mild compared to what's before us. It will become, in my view, routine that the U.S. will have, the federal government will have deficits of $2, $3, $4 trillion. Money will have to be raised to bail out the blue states. That's a policy objective. There is the infrastructure program that Biden has talked about, and that means things like building electrical vehicle charging stations all across the country, and other green-related technology, and maybe even repairing a few roads. But the priority will be on green technology. All of this will cost a lot of money. Plus, they're going to want to maintain unemployment assistance for as long as possible. And yes, we will have chronic unemployment for months and months and months. Already, as of last month, actual unemployment rose. So there were more jobs that were lost than were created. One should expect limp employment figures to continue for the foreseeable future. A number of things are happening there. It's not simply that economic growth is weak. It's more a factor of having to do with what's going on within particular sectors. So companies have had to get along with less labor. So it's no surprise that labor productivity's gone up. They found ways to do that and still maintain production. And so they're going to conclude that it flatters the bottom line to A, continue having employees work from home, or also access employees overseas online, and to automate more aggressively than they ever had before in the event that a pandemic like this returns. That is being factored into corporate thinking as well. So the prejudice against growing employment at the corporate level is going to be a factor in corporate decisions for the foreseeable future. And I don't think it's any accident that Amazon has announced that they plan to train 23 million people, which is of course larger than the entire collegiate system in the United States, worldwide, on cloud services. So what is happening there is they are quite happily displacing large elements of the university system with an opportunity that will be cheap or even free, with the ability to dangle a job at the end of it.
Very interesting.
So you're going to see numerous universities shut down. Being a professor is going to be a very difficult way of life for at least the next 5 years. Finding a job is going to be almost impossible, in my view. As the economy converts to this online version of communications, of servicing, relies ever more on artificial intelligence instead of live persons, I can't see much scope, and also automates, I can't see much scope for employment increasing. I don't think the employment rate will increase for years on end. it's going to remain below its peak of the, mid-70s? I think it hit 66% or something like that. It'll remain below that level for years and may drop significantly. And certainly while the Democrats are in power, they will be inclined to support government dependency. I'll put it that way. And it's costly. It's very costly.
So you talked about initially the oil industry, and said that it will be negatively impacted by the Democratic policies. But the oil industry is determined pretty much by the private sector, and so how will they just be able to stop fracking? Because fracking is the new technology that's been able to provide energy. Increased energy levels so that we don't actually have to import energy anymore. How would they impact or negatively impact the production of fossil fuels?
No, EPA.
Okay. So new regulations by the EPA would cut down.
Yes. Oh yeah.
But it would actually, wouldn't it first impact the price of the oil? And then the market would just use less of it, or they would be able to impact the production of the oil itself.
They want to constrict the output of oil, raise the price of oil so that it encourages the ongoing conversion of the citizenry from oil-based vehicles to electric vehicles.
But won't fossil fuels be required to produce the electricity for the electrical industry? Because obviously you have a conservation of energy in principle.
Well, look, I'm not saying it's going to be efficient, but wherever possible, they're going to try to force, and that's easy. They're going to try to force utilities to substitute wind and solar and other types of non-fossil fuel based inputs. And of course, the cost of electricity will rise, right? You have to expect that. In order to achieve their carbon footprint goals and so on and so forth. I mean, remember, reducing the carbon footprint is going to be one of the most important objectives of this administration. Not the carbon footprint of the world, because remember, since the Paris Accord was signed, 48% of the increase in carbon emissions has been from one country, China, and they signed the accord. Ours have actually fallen, but that's not good enough.
Right.
They want a radical change.
Right. Okay.
So yes, I agree that as oil prices go up for the likes of Exxon, that will temporarily be good. But what the Democrats want to see is that the prices go up so high that it makes the conversion to electrical vehicles a foregone conclusion.
Okay. Okay, Rick, thanks very much for that insight, and we'll see everybody next month on the RITE Report. And if you like this video, please hit the like button and subscribe. Thank you.